we are going to discuss the case 2-3, Lone Pine Cafe, Part A. So I think this is going to be helpful as you continue to do your advanced assignments in terms of really creating income statements or balance sheets from descriptions given by the textbook. So let us begin. It reads here, on March 31, 2010, the partnership that had been organized to operate the Lone Pine Cafe was dissolved under unusual circumstances. And in connection with this dissolution, preparation of a balance sheet became necessary. So the partnership was formed by Mr. and Mrs. Henry Antoine and Mrs. Sandra Landers, who had become acquainted while working in a Portland, Oregon restaurant. On November 1, 2009, each of the three partners contributed $16,000 cash to the partnership and agreed to share in the profits proportionally to their contributed capital, which is 1/3 each. The Antoine's contribution represented practically all of their savings. Mrs. Lander's payment was the proceeds of her late husband's insurance policy. On that day also, the partnership signed a 1-year lease to the Lone Pine Cafe located in a nearby recreational area. The monthly rent on the cafe was $1,500. This facility attracted the partners in part because they were leaving accommodations on the floor above the restaurant, one room occupied by the Antoines and another by Mrs. Landers. So let's try to see. We have to prepare the balance sheet for the Lone Pine Cafe as of November 2, 2009, and prepare the balance sheet as of March 30, 2010. So we will continue because we have to know what are the things that they have so that we can prepare the financial position statement for it by November 2, 2009. So the partners borrowed $21,000 from a local bank and used this plus $35,000 of partnership funds to buy out the previous operator of the cafe. Of this amount, so this is a disbursement, $35,000 was disbursed. Of this amount, $53,000 was for equipment and $2,800 was food and beverages then on hand. The partnership paid $1,428 for local operating licenses, good for 1 year beginning November 1, and paid $1,400 for a new cash register. The remainder of the $69,000 was deposited in a checking account. Shortly after November 1, the partners opened the restaurant. So this is already the operations that has started. So we have enough data as of now to create the balance sheet as of November 1, 2009. So now let us begin with the balance sheet. We begin with Mr. and Mrs. Henry Antoine and Mrs. Sandra Landers, who had become acquainted, $16,000 cash each. So Mr. Antoine, Mrs. Antoine, 16,000, and Mrs. Sandra Landers. So we can just say Miss Antoine capital. Okay. Okay. So that's 48,000. Initially, we should have it here, 48,000. But there will be changes in the cash. So I'll come up with the computation first of cash. So capital is 48,000. And then it says in another paragraph, there is a monthly rent of 1,500. So this is just a fact. Okay, we're not going to put it yet in the financial statements unless it says that they paid the rent. The partners borrowed 21,000 from the local bank. So bank payable. So we have here the running balance. So 53,000 was for the equipment and 2,800 for the food and beverages on hand. So the equipment, food and beverages cannot be equipment. We will separate them. So equipment, and then the partnership paid 1,428. So it is an outlay of cash. It is good for 1 year. So is it already an expense? Not yet. It is simply a prepaid expense. So we will create prepaid expense of 1,428. And then paid 1,400 for the cash register. Cash register. The remainder of the 69,000, remember there was the 69,000 was deposited in a checking account. So it's actually here, cash in bank. Let us see how much that is. 10,172. So total current assets now would be plus 28 plus 1,428, 14,400. Add 54,600 of the equipment, it will be 69,000. This is total assets. And this is 48. So this is 69. Okay, so that is the income statement as of November 1, 2009. Any question? So now we will continue, and we're supposed to get the balance sheet as of March 30, 2010. We're going to make this March 30, 2010. In response to Mr. Simpson's questions, Mrs. Antoine said that the cash registered had contained 311 and that the checking account balance was 1,030. Ski instructors who were charged. So shall we put that already? 1,030? It seems cash in bank is 1,030. Cash on hand, which is what is in the register, is 311. So that will be 1,4. Sorry. That will be 1,341. Okay. And then ski instructors who were permitted to charge their meals had run up accounts totaling 870. So we can actually put them here. Not any more cash in bank. We can just have total cash. That will be 1,341. And now we have accounts receivable. $870, which were subsequently paid in full. But at the moment, we're accounting for March 30, so that's 870. The Lone Pine Cafe owed suppliers amounts totaling 1,583. So that will be accounts payable, 21,000. Mr. Simpson estimated that depreciation on the assets amounted to 2,445. So since the cash register have disappeared, we will remove this one. Less accumulated depreciation 2,445. Food and beverages on hand were estimated to be worth 2,430. During the period of its operation, the partners drew salaries at agreed upon amounts. So we have mentioned earlier that they are going to do it proportionately, 1/3 each. The payments were up to date. The clothing that Mr. Antoine left behind was estimated to be worth 750. Are we going to consider that? These are personal assets, so we're not going to consider it at all. The partnership had also repaid 2,100 of the bank loan. So basically here will be 21,000 less. We have paid 2,100. So that is 900. So we will make this 18,900. Okay. Prepaid expense 1,428 paid on November 1 divided by 12 months 119. So what is remaining March 30 would be April up to October. So that's April, May, June, July, August, September, October. So that's 7 months. So this is 833. So this is still prepaid. The expenses actually November, December, January, February, March, 119 times 5. So that's 595 is the expense. Okay, so what is actually prepaid is 833. Okay, so something I can correct here is we have included the contents of the cash register that has disappeared. We can actually still consider in the financial statement the cash register that has disappeared, 1,400. This can actually change this. We can assume that the accumulated depreciation that Mr. Simpson has recognized already includes both equipment and the cash register. So that will be 53,200 plus 1,400 cash register minus 2,445. So that's the non-current asset plus 5,474 of current asset. That's 57,629. So if we put that here also, that will change the what will be divided would be minus 1,583 minus 18,900. That will be 37,146 divided by 3. That will be 12,382. Per partner. Okay? Did you understand that? So now we have to go to that last question. Disregarding the marital complications, do you suppose that the partners would have been able to receive their proportional share of the equity determined in question 2 if the partnership was dissolved in March 30, 2010? So actually, in the text, it says that the court subsequently affirmed that the partnership was dissolved as of March 30. Would they receive proportional share of the equity? So you have to give your opinion on that. Okay. So now let's go to the other part, the next part of Lone Pine Cafe, that is in chapter 3. So it says there that In addition to preparing the balance sheet described in Lone Pine Cafe A, Mr. Simpson, the accountant, agreed to prepare an income statement. He said that such a financial statement would show Mrs. Antoine how profitable operations had been and thus help her to judge whether it was worthwhile to continue operating the restaurant. In addition to the information given in the A case, Mr. Simpson learned that cash received from customers through March 30 amounted to 43,480, and the cash payments were as follows. Monthly payments, 23,150, wages, interest, everything. And the monthly payments to partners is 1/3 to each partner. So prepare an income statement for the period. So we can do the same Lone Pine Cafe. This time it is income statement. For the period ended, we can say November, December, January, February, March for the 5 months period, but we just say period ended March 30, 2010. So it starts with sales revenue. So we are now here in this part of determining the sales revenue. As it says in the problem, the cash sales is 43,480, but remember, we still have accounts receivable of 870, so that will be 43,480 plus 870. And then now we have to determine the cost of goods sold. So basically, we start with the beginning inventory plus purchases, or add purchases is cost of goods available for sale, less the ending inventory. So that is not sold yet. So the answer here would be the cost of goods sold. Okay. So let's begin. The beginning inventory that we had, remember what has been the beginning inventory? We had from the balance sheet is 2,800. What has been purchased? We see that in the new case, it says that cash purchases were 10,016. Do we have credit purchases? It seems that there are, because we still have 1,583. So let us compute. 10,000 cash of purchases, 10,016 plus credit purchases, because we still have to pay the suppliers 1,583. So that will be 995, 11,599. Correct? So how much is available? 998 for 13,114. Ending inventory, is that the one right now? So that will be 11,969. Okay, so that will be gross margin. Salaries to partners, we can just say payments to partners, considering their salary, that will be 23,150. And salaries, or salaries and wages, 1,480. And then utility, 8,270. And then operating license expense. License expense. Remember, that was the prepaid. So now we have the expense portion, which is 595. Okay, so total expenses would now be 42,695. Okay. So operating income, that will already be a net loss because the gross margin is 32,381. 32,381 less expenses of 42,695. That will be net loss of 10,314. Okay. Would there be anything else that we have to add here? It's possible that we can compute for the bank payable if we have more data, but we can add that. Is there any tax payable? No, because this is a net loss. Okay, so I hope with that you have better idea of what things go into the balance sheet and what things go into the income statement. And I think something new for you here would be an application of the cost of goods sold. So basically, it's like a story. You begin with what is there, and then you add still some more things to buy, like more food and more beverages, for example. And then to find out what has actually been sold, you compute for what is there on hand, which is the ending inventory. So you come up with the cost of goods sold. So basically, what you have on hand plus your purchases is equivalent to what is available for you to sell, less the ending inventory would be the cost of goods sold. Okay, what else would be new? Remember that with the revenue, that includes cash and credit revenue. Okay, and then when it comes to purchases, that will include also cash purchases and including what still is accountable because it's already with you, except that you have not paid for it yet. Okay, so I hope with that you learned something more about accounting. I hope you enjoyed it a little bit more, okay? Or at least you have understood it better. Bye for now.